Good day, ladies and gentlemen, and welcome to my webinar on my favorite trading strategies. Today we're going to review three of the most popular online trading strategies. Now, using a trading strategy, a trader develops for himself a set of rules that helps to take advantage of online trading. Okay. Trading strategies don't need to be very sophisticated. They need to be well planned. You need to not jump into a trade just following your emotion or your gut feeling. You need to have a set of steps to follow to make your final determination. Now, quite often traders rely on trading strategies that haven't been tested thoroughly. Because believe me, what you think or what you saw in your head last week and the week before that worked really well for you and going with your gut feeling might not work in tomorrow's market, or might have only worked well because those particular assets were doing something at that period of time, but don't work next week or next month. Okay. You can't rely on something that has not been tested and back tested. So the reason that we use or start our basis with someone else's or well-developed trading strategy is because they've been tested. Now we modify, we make it our own, but you don't need to spend forever. My trading strategies, and I've been trading since the 1970s, now we didn't have online trading then, are very simple. The truth is you can spend hours searching all over the internet for the right strategy, and you'll have no luck in finding one. Because to be honest with you, most strategies are not that detailed from the internet that you can know everything that is in that trader, writer, guru's head. I can explain to you in great detail my indecision strategy. It works for me all the time, except I can't get all the little things out of my head. If you sat there for 2 days asking me questions, I might be able to answer them all for you. But at some point, you have to take the basics, the bones, and then put the skin around it, put the, and make it something. I give you the skeleton. Okay, we give you a skeleton that's got the right set of bones for you then to decide whether it's going to be tall, short, black, white, hairy, smooth, red hair, green hair, whatever. Okay, but you always have to make them your own. So before discussing trading setups and possible strategies, we need to first understand why would we consider trading Forex in the first place, or cryptocurrencies, or today ETFs, any type of online trading. But the most popular online trading in the world is Forex, followed by cryptocurrency, and cryptocurrency is taking that market over fast. But we also have trading ETF stocks, gold and oil, commodities. There's so many variations and assets today that we can trade online. Now, there are two main reasons that people trade: hedging and speculating. In most cases, okay, and I would think everybody watching this video are not hedgers. They just aren't. Okay. Hedging is today become more of a business practice than it had, or a risk management practice. Most of us are speculators. Okay. We speculate. We're looking to make profit on simple moves in the market. We don't really care about the true value of an asset. Okay. We don't care that Google is at 427, but if we did all of our valuation, it should be trading, it's worth 430. We don't care. We care that it was 432, fell to 427, is most likely going to go back to 430, so we can make some profit there. Or something happened in the overall market and Google's trading at 432, and it's going to take a nosedive. It has nothing to do with what Google's actually worth. It has to do with speculating prices in the market, making profit in between. So we will concentrate on speculators. They're like you and me. Now, Forex trading strategies come in all different shapes and sizes. So before we jump into any of them, we highly recommend you test drive them first. Now, speculators refer to predicting a move that a company or an asset might make in a certain situation. If done correctly, these predictions greatly improve trading results. Speculation is what day trading, let's forget the word day trading, let's change short-term trading, is all about. With the help of decent strategies, we can progress in the Forex cryptocurrency online trading world and ultimately develop our own strategy. The downside is that this is a time-consuming and difficult process. It is a process that continually develops as you become a more knowledgeable, more aware, more experienced trader. Now, the good news is that there are many pre-made strategies available for you to try. And like I said, these pre-made strategies can give you the skeleton. It'll give you the skeleton and the good bones. From there, you take it and put it together. So although it's better to play it safe, especially if you're new to the game, you need to change your tactics from time to time. This may allow you to see a profit margin that could have otherwise been missed. So here we're going to look at some of the most basic online trading strategies to give you a point. Now, each one of these we're going to look at, you can click on the internet and get a very detailed process for each one of these strategies. But again, it's not going to give you everything because it's not going to give you what in your head. It's going to give you, again, the steps to get started. So we're going to provide you with an overview of strategies that have worked for many years so that you can research the ones that you are interested in. These are the trading strategies that could work, and they have been proven to work by many traders many times. Okay. And again, they will then allow you to modify them, define them, and improve them to make them the best for you. So before we look at our top trading strategy list for 2022, we should start by considering some of the most important trading tips. So after all, while the right strategy can help boost the chances of success with your trading efforts, there's only so far that they can take you. For the best results, then you must also consider some of these key following tips. Remember, any strategy should incorporate risk management. Now, I can't emphasize this enough. Okay. Trading is about knowledge, experience, controlling your emotion, and risk management. And then we're going to go back to more risk management, and then more risk management, and then back to knowledge and experience. Because you can slowly gain that knowledge and experience if you're using risk management so you don't lose all of your money instantaneously. Okay. Risk management is what you do, even when you're an experienced trader, to control your losses. And believe me, trading is about maximizing your profit and minimizing your losses. So nobody, including myself, is successful in 10 out of 10 trades. I mean, we're lucky if we're successful 4 out of 10 trades. But if the 6 losing trades, the 6 incorrect trades, the 6 non-profitable trades had small losses, and the 4 profitable trades had good profit, your net would have been a net profit. And that's all that really counts. Are you continually adding to your account, not individual trades? Now, we always want to implement a trading plan. This does not just include, oh, I'm going to trade that asset and I'm going to trade it now at this point. It includes your entry point and how you're going to develop it, your exit strategy. It's going to talk about what type of trade you want to set up. You want to set up a GTD, an OCD, a market trade, a limit trade, all of these kind of things. There's many points that you need to be aware of and work out. Risk management, stop loss, exit points are ultimately important. But how do you pick your profit target? Because you need to be able to pick a profit target to be able to set it against where you'd have to put your stop loss for that trade, to calculate your risk reward ratio to see if it's even worth making that trade. Okay. Now, these steps may make it easier to determine when to change your policy or otherwise when to cash out. Okay, cash out. Everybody should have an exit strategy, whether you're exiting it because the market moved against you at a loss, or whether you're exiting your market at a profit. You can't just put a target price and sit back and go to sleep and say, I'm going to get rich tonight. It doesn't work that way. You have to have an exit strategy because the markets aren't going to do exactly what you think they're going to do anytime. Now, for instance, I watch an asset when I've entered a trade, and if it goes up to my preliminary target point, I move my stop loss up to that point. Okay, I've already now locked in profit. So even if the market turns against me and I get stopped out, I've been stopped out in profit. But then when it gets to my point B, I then close half of my trade at profit and move my stop loss up closer. No matter what happens in the market at that point, I can't lose money. I've locked in my profit, but I still have my trades running. Okay, this is all part of your trading plan. So it is managing risk. CFD or online trading is potentially risky business. As such, a critical tip we can give online traders, whether new or experienced, is to manage risk to determine suitable policies and overall continuality. After all, while it can always be tempting to push for greater returns, this can represent potential losses. Now, one of the most popular trading strategies today, and it's going to sound so easy, but a trading strategy doesn't need to be easy. Okay, it's all the things you do around that strategy: exit points, entry points. Because a trading strategy is going to tell you that you have a buy opportunity or sell opportunity, and make the determination that you want to make a transaction. The rest is built around your strategy. So trend trading means trade in the direction of the markets when the markets are exhibiting a well-qualified, well-defined trend. Okay? And believe me, this happens all the time. It's not something hard to get. Okay? When you see an asset push and ease, push and ease, push and ease, push and ease, that's a well-qualified uptrend. An asset is making higher highs and higher lows, higher highs, higher lows. And these little eases in between are good things. They're not bad things. We need push, take a breath, push, take a breath, push. When you see this, you can easily enter a trade within that trend, because a trending market, and the more well qualified, the more well defined that trend is not rare, but it's hard to find. But it takes a lot of effort by a lot of traders to get a market to start trending. It's like a locomotive. It takes a lot of energy to push that locomotive forward, and it starts but once it gets up to full speed, it's flying a mile a minute. And when you read that it's going to take 5 miles for that train at 60 miles an hour to stop, it's because it can't stop on a dime. Well, neither can the Forex market or the online trading arena. Okay, so when you see this locomotive that's now pushing in full gear, all the wheels are working, the steam's coming out, well, you that are in a point in which you know you've got 5 mile safety net. Okay. And this makes for a very nice trading strategy. So trend trading is one of the most reliable and simple trading strategies. As the name suggests, this type of strategy involves trading in the direction of the current trend. In order to do so effectively, traders must first define the overarching trend direction, duration, and strength. All of these factors will tell them how strong the current trend is and when the market may be primed for reversal. In a trend trading strategy, the traders don't need to know the exact direction or timing of the reversal. They simply need to know when to exit their current position to lock in the potential earnings and limit losses. Now, that sounds pretty easy, isn't it? And it works. All the other things around it are what's difficult. The exact price you're going to enter, Okay, where are you going to put your stop loss? Where are you going to put your take profit? How you're going to exit your trade? Even when a market is trending, there are bound to be small price fluctuations that go against the prevailing trend direction. For this reason, trend trading favors a long-term approach known as position trading. While investing in the direction of a strong trend, a trader should be prepared to withstand small losses with knowledge that their potential earnings will ultimately surpass the losses. So in other words, you don't want to panic. Because like I said, the market goes, oh, come on. Sometimes I hate these markers. I'm trying to turn on my highlighter. There we go. The market goes like this. And we don't want to panic each time it goes like this. And if we like to trade that market, we'll never get in here. Okay? But we don't want to necessarily take a trade here because at some point we know it's going to ease back down. We want to wait for that retracement. We'll never find the bottom of that retracement. That's like trying to catch a falling knife. But when the market's turned back up and is surpassing its, re-energizing the previous move, that's the perfect point to enter. Now, to determine the direction and strength of the current trend, traders often rely on simple moving averages, exponential moving averages, indicators like MACD, okay, or AAD or ADI, average directional index. There are many indicators that'll help you, but also your eyeballs will help you. All moving averages are lagging indicators that they use past price to extend context to current markets. Almost all indicators are lagging indicators because they have to be calculated using numbers that have already happened. The open, the close, the high, and the low. Okay, so they're always slightly lagging, but some lag the markets more than others. But they're better at telling you the market has changed direction. They're much better at letting us know that maybe we should be getting ready to exit our trade. But they're tools that will help us. So rather than anticipating the direction of the reversal and entering a new position, trend traders will use these signals to exit their current position once the new trend is manifested. Traders will once again trade in the direction of the current trend. Now, to trade effectively, however, it's important to confirm the direction and strength of the new trend before entering a position. Although you may not be able to be the first one to enter a trade, being patient will ultimately shield you from unnecessary. You don't ever want to be the first. You want to be the guy where you've heard the locomotive take off, the train starting to move, you hear the chuck, 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 chuck. But then you hear the caboose whistle like an old western. It's gathered strength, and now it's moving down the track. You want to enter when it's moving down the track. You don't want to be the first. You don't want to make the most money. You don't want to take the most risk. You want to enter at the right point when it's already gathered up that steam, so you know it's going to take 5 miles for it to stop. The next type of strategy is called position trading. Okay. Now, I'm not a position trader. Okay. Sure, I kind of understand it, but I don't ever use it. Okay. Position trading is a strategy in which traders hold their position over an extended time period, anywhere from a couple weeks to a couple years. For us, it's a couple hours to a couple days. It's more of a long-term trading strategy. This approach requires traders to take micro view of the market and sustain smaller market fluctuations that counter their trend. In other words, the euro-US dollar is trading at 106. Well, it might go down to 105, 104, but by the time things settle down in Europe, for some reason, it's going to go back up to 108. So you take a position at 106 and you sit for it to go back to the 108. Okay, it's really not something great for online trading. Okay, it takes too long, and if you're using leverage and margin, you're keeping your trades open for way too long, and you're risking these market fluctuations that might stop you out. But it's very good for looking at longer range investing. And then the third best strategy, and actually it's one of my favorite. I'm a trend. I am a what I call a price action trader. I trade using my eyes and my charts. I always use support and resistance. I always use trends. I don't use indicators. Now, range trading is a great little trade. There are assets all the time, no matter what class size, that have found a range in which they're trading, where today and yesterday, this whole week, they're pushing up to this significant level, but not able to bounce through it, falling back down, bouncing off of that level, and trying to make it back to the top of that little range. Okay, we call these levels support and resistance levels. Well, it's very easy to buy whenever the price comes down to the support level and bounces off, because we know most likely it's going to move up to this resistance level and not break through it. But if we had bought down here and even if it breaks through, we end up making profit. Okay. If it doesn't make that far, like in this case, it still eases back down and eventually makes it. It's either going to have to break above that resistance level or fall below that support level while it does. But while it's trading, making these double bottoms, triple tops, whatever we want to call them, they make a great little trade. Range trading is based on the concept of support and resistance. Once a price action graph and once we've looked at a graph or chart and we've identified these support and resistance levels, we can trade as the highest and the lowest point the price reaches before reversing the opposite direction. Together, these support and resistance levels create a bracketed trading range. In a trending market, price will continue to break previous resistance, forming higher highs as an uptrend or lower lows in a downtrend, creating a stair-like support and resistance pattern. Okay, we talked about entrance, push, ease, stair, step up the stairs, down the stairs, up the steps. Okay, in range trading, we're jumping up 2 steps, going down 2 steps, back up the 2 steps, down the 2 steps, up the 2 steps. And that's exactly what it will be. So price is in a sideways pattern and remains bracketed between these established support and resistance areas. When price reaches the overbought or the resistance level, traders anticipate a reversal in the opposite direction to sell. Similarly, when price approaches the oversold or support level, it's considered an buy signal. So imagine we have one of those little 3-step ladders that we use in our kitchen, to climb up to our upper cabinets. Now, you can climb step 1, step 2, step 3, stand up there, and maybe step onto the cabinets to get up higher. Okay. And while you're climbing up those steps, you're in an uptrend, and that uptrend is going to continue going up. But if you went, say you were exercising, you went up 2 steps, stepped down the 2 steps, went up the 2 steps, went down the 2 steps, never climbed to that 3rd or 4th step, up the 2 steps, down the 2 steps. Where are you? You're in a range trading. Maybe you're exercising. Maybe you're going up and down, putting a dishes in the cabinet. You have to go up 2 steps to put them in. You're going down, grabbing another one, putting it up. But that's a range. Range traders are less interested in anticipating breakouts, which typically occur in trending markets, and more interested in a market that oscillates between these 2 points. And it's amazing. You'll see this happen all the time on charts. It's not hard to find. Sometimes you have assets. Look at what cryptocurrency did for almost 10 days between 29.5 and 31. It went up, and all of a sudden the markets are it's climbing back up. It hit 31, went back down and broke below 30, went back to 31, down below 30. You could have range trade that up and down for days. Range traders use support and resistance levels to determine when to enter and exit trades and what position to take. To do so, they often use banded momentum indicators such as stochastics, oscillators, and RSI to identify overbought and oversold zones. Trading the dips and surges of ranging markets can be a consistent and rewarding strategy. Oftentimes, an asset will remain overbought or oversold for an extended period before reversing to the opposite direction. To shoulder less risk, traders should wait to enter a new position until the price reversal has confirmed. So the online trading market offers many opportunities for both profit and loss. In order to have a chance at creating potential profits, traders need to choose a strategy and stick to it for consistent trading results. Okay. But remember that trading strategy is only the part that's determining your buy or your sell and what you're going to do. You still have to develop your risk management, your stop loss, your target points, what you're going to use for entry, what you're going to use for exit. Okay, remember that is what makes you the successful trader, or the guy who's not losing his shirt. You won't get lost if you follow a basic strategy and set your basic rules without making things overcomplicated. So thank you very much for joining us, and I hope you learned a little bit today.